Welcome back. You're still watching Trading Hour, and let's bring you some interesting market opinion from earlier today. We caught up with Ajay Srivastava, who's CEO of Dimensions Corporate Financial Services, and he says that this may be the best time to enter the fixed income market. Listen in.
There's a good Samvat this year, but only fact is, depending on from where you look at the whole market, it's like an economy is like a glass half full. You know, some people feel optimistic that, listen, the worst is behind us. Some people can feel pessimistic that the interest rate and inflation will come through and the demand is slowing down. So it just depends upon where you look, from which side of the market you look at it, and you decide whether you want to be optimistic or pessimistic. But one thing we know for sure, and I think that's what the market has taught us, is that the paradigm of this long-term investment concept is gone now. I think you need to learn to be flexible, fast, nimble, and get out of stocks once they reach a good point of valuation from a comfortable point of view. This is the best time to allocate, and you have not done it, a lot of investors have not done it for a while, to go into fixed income. If fixed income will give a better return, it has given better return. If you look at 5-7 years, it's given very good returns when you were in the last cycle of rate increases and you rode the whole capital gain right up to the point where post-COVID happened. I think the same cycle is happening. You will get better returns than equity markets broadly. And we've seen oversubscription of, just now we saw the bond subscribed at 7.9% interest for 25 years. Now, these kind of opportunities come once in a while. So there is a clear case that one needs to pedal down a little bit your equity inclination, no matter how exciting it looks, and move a lot of your money into the fixed income. And that's where they're given money. We didn't follow the Hong Kong model, right? So therefore, our market cap of real estate companies has been minuscule compared to what happened in the magic period of Hong Kong or Singapore. And unfortunately, the companies in India have not given returns to shareholders. So it doesn't depend on the market, whether you invested in a DLF or a Prestige or whatever, your rate of returns have not been lucrative. Of course, one can argue that the macrotech has done good post the IPO. There's no doubt about it. But broadly, in a longer term time frame, for whatever reason, I'm not attributing any motives to it, but somehow or the other, the shareholder never makes return. I think there are a lot of companies which are very undervalued in pharma space. To be honest, so most companies have been valued at in a single-digit P's kind of stuff, and they will gain tremendously from rupee dollar depreciation. There is no doubt about it. But the caution here is that this flower is like the, I don't know the name of the flower, but which once blossoms once in 20 years, somewhere in Himalayas or something. This pharma is that like flower. You need to catch it at the once in 20-year phenomenon. Yes, I was a great votary for pharma. We made good money, but then it became so sluggish that the return on capital employed became negative. If I look at last 20 years or 15 years, pharma has been the biggest loser in my portfolio in terms of return to capital employed.
Okay, that's the word coming in from Ajay Srivastava, but lots of pearls of wisdom from our experts in this Samvat session. Let's do one thing. Let's take a quick break. When we come back, we'll be joined by G.S. Chalal, the Chief Financial Officer at Make Money Organics, to discuss the company's Q2 earnings. Stay tuned.